Hello and welcome to our special edition investment review, which will come as no surprise to anybody, is to discuss the Brexit. We're sending this review ahead of the forthcoming referendum so that we can appraise you of our thoughts in so much as they are relevant to the decisions that we make about our investments. The outlook for the outcome of this referendum is unclear, and it would be a brave person indeed who tried to call it. Polls are suggesting it'll be a close run thing. I've been looking at a mix of betting websites on the internet, and the same here seems to be true, with the Leave vote gathering some more pace. As I say, we can't begin to guess or predict the outcome, but we know obviously that it has potential effects for all of us. Housing, markets generally, jobs, sterling, all stand to be affected. The list is well publicised and televised, and I shan't bore everyone here with unnecessary repetition. There has been much noise made about what the effects will be on the economy. If we leave the EU, then a shallow recession is predicted. It has been stated that it will be one of the most shallow recessions in the last 4 decades, and arguably may happen even if we stay inside Europe. Market volatility is likely to increase, but it's not to be confused with the recent raft of soft economic data which contributed to last week's late Friday afternoon sell-off. The two things, soft data and referendum uncertainty, conspire to make markets very volatile. As we know, markets dislike uncertainty. So if we're to think of the effect on our currency and markets generally, broadly these are the same as in March. Weaker sterling does help exports, but the margin of correction suggested by many is within what might be called normal. The same is true for markets. Oil prices brought the FTSE 100 down early this year to the lowest post-leave levels suggested by a mix of experts. Markets have been lower than present despite their distance from the European discussion. So we need to give consideration to the options. We can switch into cash and see what happens. What are the risks of doing this? We would miss any market upturn if the referendum has been the cause of market pressure. Also, we would need to carefully determine when to re-enter our investment regime, and timing is very difficult to predict. We could simply stay as we are. We have to consider the possible outcomes. A lift in markets if we stay in, if the uncertainty is the real cause for the lower values we are seeing, or a drop in values if we come out. However, this drop is likely to be short term and removes timing risks. We have anecdotal evidence of situations where people have tried to call the markets and the psychology has won through, where their decision to return to the markets has been left too late and that bus has driven by. Our view is that we should stay as we are. If anyone does choose to switch to cash, then we would advise that the move back into the markets takes place as soon as possible after the result is known. The markets are set to try us perhaps even more than the endless political rhetoric, but experience suggests that a cool head and a focus on the longer term will stand us in good stead. I'll bring this to summary. I've tried to be extremely succinct because no doubt it's possible to become very weary of all the reading around this. We're suggesting a hold tight position. If you are concerned or you wish to discuss the outlined alternatives, then please do contact us. During the run-up to the referendum, we will of course remain vigilant, and if our view shifts at all, we will be immediately in touch. All of our contact details appear on the next slide as usual. Thank you for listening.